Usually when you walk out of your house, you probably pass like a dozen commercial buildings without even really seeing them.
Oh, yeah, completely. They just, become part of the background.
Right. You drive past the corner strip mall, the local vet clinic, the industrial park on the edge of town, and they all just sort of blend into the scenery of your life.
Yeah, just totally invisible.
Exactly. But imagine for a second that you could put on a pair of X-ray glasses. Suddenly, you aren't just looking at, brick and glass and asphalt anymore.
You're looking at cash flows.
Yes. You're looking at highly calculated bets on human behavior. And perhaps most importantly, you're looking at some of the most sophisticated, legally protected wealth-building strategies in the American economy.
It really is a completely different landscape when you look at it through that lens. I mean, every single building tells a financial story. And frankly, a lot of those stories are about risk, timing, and tax strategy.
And unlocking that story is our entire mission today. Welcome to this deep dive into the hidden mechanics of commercial real estate investing. It's going to be a fun one.
It is.
Yeah.
Because by the end of our time together, you're going to be able to look at that boring everyday strip mall in your neighborhood and understand exactly how the wealthy use it to grow capital and, legally dodge massive tax hits.
Yeah, the tax side alone is mind-blowing.
Right. So to do this, we are decoding this really fascinating insider document. We've got our hands on a highly detailed, curated newsletter dated August 1st, 2026.
Fresh off the presses.
Yep. It's from the Eureka Business Group, or EBG. They're a Texas-based retail investment advisory firm, and they've been operating since 2008. So whether you are, actively looking to invest, or you just want to understand the secret chess game being played with the real estate in your own city, this deep dive is for you.
The fact that EBG has been operating since 2008 is a detail we should probably underline right away.
Oh, because of the crash.
Exactly. That means this firm cut its teeth during the Great Recession. I mean, they have seen the absolute bottom of the real estate market. They survived it, and they've navigated every boom and bust since. That's a lot of institutional knowledge.
It really is. When a firm with that kind of scar tissue sends out a curated list of opportunities to their investors, they aren't just, pulling random listings off the internet. They're applying a very specific, battle-tested philosophy to what actually makes a physical property valuable.
Okay, let's unpack this philosophy starting right at the top of their newsletter. Because they kick things off with a sort of macroeconomic weather report.
Right, setting the stage.
Yeah. EBG notes that it is, quote, still hot tea here in Texas. But more importantly, they highlight that the Federal Reserve did not change interest rates this week.
Which is a huge detail.
Huge. From that one single data point, that interest rates stayed flat, they conclude that investors are deep in the buy zone. Their explicit advice to clients is to identify a good deal, make an offer to make it a great deal, and buy. They even warn that sitting on the fence equals later regrets.
Oh, pretty bold stance to take.
It is. And I have to push back on this a little bit because we see this all the time in sales, right? Is this just a classic broker pitch? The real estate guy standing on the beach telling everyone, come on in, the water is fine, just so he can generate a commission? Or is there genuine strategic value in buying when interest rates are flat rather than waiting around for them to eventually drop?
What's fascinating here is the underlying psychology of a stagnant interest rate and how it completely changes the math for a professional investor.
How so?
Well, we tend to think that lower rates are always better. But commercial real estate actually thrives on predictability. When interest rates are wildly fluctuating, even if they're dropping, it creates a chaotic environment where nobody knows what a dollar will cost tomorrow.
Right, because you can't plan.
Exactly.
Yeah.
A pause, a completely flat rate, gives investors a solid floor to stand on. It allows buyers to underwrite their deals accurately without guessing.
Okay, I hear that term underwrite thrown around a lot in finance. For someone listening who might not be a banker, what are we actually calculating when we underwrite a property?
Underwriting is essentially building a financial model of the future. You're calculating all the expected income from the tenants, subtracting the operating costs, and then figuring out exactly how much your loan payments will be over the next, say, 5 to 10 years.
Ah, I see.
Yeah, so if you know exactly what your capital is going to cost you today because the Fed paused rates, you can accurately project whether a building will actually make you money tomorrow. EBG is basically arguing that this predictability is just as valuable as cheap money.
That makes a lot of sense, but it doesn't entirely clear them of the whole commission-hungry broker stereotype, does it? I mean, they still want you to buy, so they get paid.
True. But they do address that directly by pointing out their specific business model. In the opening paragraphs, EBG emphasizes that they have, quote, post-closing accountability.
Post-closing accountability.
Right. They aren't just transaction coordinators who vanish once the papers are signed.
Meaning what exactly? Like what happens after the closing?
They explicitly state that they'll be there to help you lease and manage the asset you purchase.
Oh, wow. Okay, that's different.
It completely changes the incentive structure.
Hmm.
Think about it. If an advisor is on the hook to manage the property, collect the rents, and keep the tenants happy for years after you buy it, they are inherently incentivized to steer you away from a nightmare property.
Cause a bad building becomes their headache, too.
Exactly. So they're going to look for stability, which leads us perfectly into the actual properties they're pushing.
Right. Let's look at those properties. Since EBG says we're in a buy zone, we need to know what they consider a safe buy in an unpredictable world.
Right.
And they have a whole tier of listings under the $3 million mark, and two of them really jump out. First, there's a 10,500 square foot vet center in Austin.
Oh, yeah, the pet healthcare one.
Yep. It's fully leased to two operators. It sees over 75,000 vehicles per day at its intersection. It has annual rent increases built into the contract, and EBG explicitly labels it as recession-resistant pet healthcare.
Which is a great label.
It is. Then you have a smaller 3,884 square foot retail space in Pflugerville. It's leased by the nation's largest dental group. It has a corporate guaranteed lease, and there are 6.2 years remaining on the primary term.
Okay, so a vet and a dentist.
Right. And here's where it gets really interesting to me. We hear constantly in every business headline that brick and mortar retail is dying. The internet won. E-commerce is eating the world. So is buying a physical space for dog checkups and root canals the modern equivalent of building a medieval moat around your investment portfolio?
That moat analogy is spot on, actually. We really have to separate retail into two distinct categories if we want to understand EBG's strategy here.
Okay, what are the categories?
Well, there's commodity retail, things you can easily buy on the internet like books, electronics, or clothes. That sector is absolutely vulnerable.
Sure, Amazon basically owns that.
Right. But then there is service-based experiential retail. You cannot get your teeth cleaned over a Zoom call. And you definitely can't get your golden retriever's leg x-rayed via an app on your phone.
Yeah. No matter how good the fiber optic internet is, the dog physically has to go to the vet.
Exactly. And that physical requirement is the moat. EBG is targeting assets that are structurally immune to the e-commerce effect. Let's look at the specific defenses they highlight, starting with the Austin Vet Center. They mentioned that 75,000 plus VPD, that's vehicles per day.
Which is a staggering amount of traffic. But I always see that acronym, VPD. Why is that specific number so critical to a commercial real estate investor? Does it just mean the area is busy?
It means built-in, free advertising, and ultimate convenience. If 75,000 cars are driving past your vet clinic every single day, the operators don't have to spend a fortune on Google ads.
Oh, the building is the ad.
Exactly. The physical building acts as a billboard. When a dog gets sick, the owner already knows exactly where the clinic is because they sit at a red light next to it every morning on their commute. High visibility ensures the tenant makes money, and a tenant making money pays their rent on time.
Okay, so the Austin property is defended by traffic and the nature of the service. What about the Pflugerville dental office? Because it's much smaller.
The moat in Pflugerville is purely financial. Notice that EBG doesn't just say it's a dentist. They specify it is leased by the nation's largest dental group with a corporate guaranteed lease.
Walk me through how that actually protects the buyer. Like if the local Pflugerville branch has a terrible year and nobody gets a cavity, how am I protected?
Well, with a standard lease, if that local dentist goes bankrupt, they break the lease and you're stuck with an empty building.
Right, worst case scenario.
But with a corporate guarantee, the parent company's national balance sheet is on the hook. If the Pflugerville location misses its revenue targets and shutters its doors, the massive corporate parent company is still legally obligated to pay you rent for the remaining 6.2 years of that primary term.
Wait, really? Even if the building is closed?
Even if it's completely dark, you are essentially buying the creditworthiness of a massive national corporation, just wrapped inside a small brick-and-mortar shell.
That is wild. Okay, so if pet healthcare and corporate dentistry are the safe defensive plays, how do investors play offense? Because EBG's next tier of listings, the $3 million to $7 million range, it shifts gears entirely. They're pushing what they call value-add opportunities.
This is where we see the actual mechanics of real estate wealth creation. Defensive plays preserve your money. Offensive plays multiply it.
Well, some of these offensive plays seem totally counterintuitive. Like, there is a retail center listed in Dallas. It's 11,338 square feet, offered at $350 per square foot. It has 63 parking spaces. And EBG's primary note on this multi-million-dollar property is literally vacant equals value add.
Yeah, that catches people off guard.
It caught me off guard. I have to play the skeptic here. How on earth is a completely empty building a selling point? If I'm an investor, isn't buying a vacant strip mall like buying a car without an engine and trying to call it weight reduction? Where is the actual value?
Your car analogy is funny, but in commercial real estate, if we connect this to the bigger picture, a better analogy might be buying a blank canvas.
A blank canvas.
Yeah. The value of a commercial property is heavily dictated by a very specific metric. It's net operating income, or NOI. It's simply the total income the building generates minus the operating expenses.
Okay, basic profit.
Right. But if you buy a building that is fully leased out on 10-year contracts at below market rents, your hands are completely tied. You can't legally raise the rent until those leases expire, which means you can't increase the value of the building.
I hear blank canvas, but I also hear zero cash flow while I pay a massive mortgage. I mean, how long can an investor realistically sit on an empty building while they try to find these high-paying tenants? It sounds incredibly risky.
It is absolutely higher risk, which is why it requires a specific type of well-capitalized investor. You need enough cash reserves to cover the holding costs, the mortgage, the property taxes, the insurance, while the building sits empty.
Right, because the bills don't stop.
Exactly. But the upside is astronomical. Because it's vacant, you get to immediately set the rents at today's highest market rates.
Oh, I see.
If you buy that Dallas property, invest some capital to modernize the facade, and sign new tenants at top-tier rates, you drastically increase the net operating income. And because commercial buildings are valued as a multiple of their NOI, you've effectively forced the building to be worth millions of dollars more in a very short period.
So the lack of tenants isn't a bug. It really is a feature for someone with the cash to survive the transition.
Yes, exactly. And EBG highlights a different kind of offense strategy with an Arlington retail center. It's a 10,405 square foot building, built in 2003, 100% leased, with over 27,000 vehicles per day.
Okay, so not vacant.
Not vacant. But the key note here is, quote, gross leases equals NNN conversion upside.
NN triple net. You see this term everywhere in real estate circles, but it rarely gets explained. What are the three nets, and why is converting a gross lease to a triple net considered an upside for the buyer?
Sure. In a standard gross lease, the tenant pays a flat rent amount every month. Out of that flat amount, the landlord is responsible for paying all the property taxes, the building insurance, and the maintenance costs.
Okay, sounds normal.
It is, until things change. If property taxes suddenly skyrocket in Texas or the roof starts leaking, the landlord pays for it and their profit shrinks.
Which happens a lot.
It does. But in a triple net, or an NNN lease, all three of those nets, taxes, insurance, and maintenance, are shifted directly onto the tenant.
Wait, so if the property taxes go up, the tenant's bill goes up, not the landlord's?
Exactly. The tenant pays a base rent to the landlord, plus their pro rata share of all the building's expenses.
But why would a tenant ever agree to that? Aren't they taking on all the risk of an aging building? Like, if I own a small sandwich shop in that Arlington center, I don't want to pay to fix the landlord's parking lot.
They agree to it because the base rent in a triple net lease is typically much lower than in a gross lease. It's a trade-off. The tenant gets a cheaper base rate, but takes on the variable costs. And for the investor, this is the holy grail. Your income becomes protected against inflation. EBG is looking at this Arlington property and saying, the current owner is using old school gross leases. Buy this, and as those leases expire, convert them to triple net. Instantly, you drop your expenses to near zero, you increase your net operating income, and boom, you have aggressively added value to the property.
That's brilliant. And they use a similar logic for another value-add property in Roanoke, right? It's a massive 16,800 square foot industrial flex property. EBG notes it's just outside city limits, has AC-equipped offices, outside fenced storage, but they point out that the current leases are short-term.
Building on that blank canvas concept, short-term leases offer incredible flexibility. It means a buyer doesn't have to wait 5 years to make changes.
Right.
They can quickly transition the property to an owner-user, like a plumbing supply company that wants to own the building they operate out of, or they can just bring in new industrial tenants at higher rates.
Okay, so let's put this all together. Let's say I follow the playbook. I buy the risky, vacant Dallas property. I survive the holding costs, I fill it with great tenants, and I drastically increase the NOI.
It sounds like a great deal so far.
Yeah, suddenly, this building I bought for $4 million is worth $7 million. I decide to sell and take my profit. But this leads us directly into the heavyweight tier of EBG's newsletter and a massive problem that successful investors face, the IRS.
Oh, yes, the tax man.
Right. The government is going to want a huge cut of that $3 million profit in capital gains taxes. How does EBG advise getting around that?
Well, they solve it with their heavy hitter listings. The newsletter features a massive property in Houston. It's a 32,196 square foot retail center built in 2019. It is 100% leased, anchored by a Family Dollar and a Dollar Tree, and sees a staggering 51,000 plus vehicles per day.
That is a monster property.
It is. But crucially, right at the bottom of the newsletter, EBG heavily promotes their custom 1031 exchange timeline calculator, warning investors, don't miss critical deadlines.
So what does this all mean? Most of us tuning in aren't dropping over $7 million on a Houston strip mall today. What is the magic of this 1031 exchange? Is it basically like playing the board game Monopoly, where you trade up your 4 greenhouses for one giant red hotel, but without having to pay any taxes to the banker in between?
That is arguably the best way to visualize it.
Mm.
I mean, this raises an important question about how generational wealth is actually built and maintained in real estate.
Yeah.
It's not just about making a profit, it's about keeping it away from the tax man.
Exactly.
Section 1031 of the IRS tax code states that if you take the proceeds from the sale of a property and reinvest them into a new like-kind investment property, you can defer paying capital gains taxes.
So walk me through the actual math on the timeline here, because EBG seems very concerned about these deadlines.
Let's use your Dallas example. You bought for $4 million, sold for $7 million. Usually you'd owe hundreds of thousands of dollars in taxes on that $3 million gain. A huge chunk of your wealth just gone.
Right. Painful.
Very. But if you use a 1031 exchange, you take that entire $7 million and roll it into a new property. But the IRS doesn't let you sit on that cash forever. From the day you sell the Dallas property, you have exactly 45 days to formally identify the new property you want to buy.
Wait, 45 days?
Yeah, 45 days.
That sounds incredibly stressful. You have a month and a half to find a multi-million-dollar building that perfectly matches your funds and clears all inspections.
It is incredibly stressful, and then you have 180 days to actually close the deal, which is why EBG provides that timeline calculator, and more importantly, why they provide the Houston listing.
Oh, I see where this is going.
Right. That 32,000 square foot center anchored by Family Dollar isn't a value add project. It's already fully leased. It was built recently in 2019, so it doesn't need a new roof. You aren't buying that to fix it up.
You're buying it because you're out of time.
Exactly. You're buying it because your 45-day window is closing, and you need a massive, safe parking lot for your millions of dollars.
You essentially kick the tax can down the road forever while using 100% of your money to buy a bigger building.
Yep.
You've moved from the high-stress, active management of fixing up an empty building in Dallas to the low-stress, passive income of a corporate-anchored megacenter in Houston.
It becomes a wealth preservation engine. And EBG caters to that entire ecosystem perfectly. They find the gritty deals for the aggressive value-add investor, and they provide the pristine landing pad for the wealthy investor trying to beat the 1031 exchange deadline.
It really is a fascinating ecosystem when you lay it all out. If we recap EBG's core playbook from this single August 2026 newsletter, the strategy is remarkably clear. First, you don't need dropping interest rates to buy. You just need a flat rate so you can accurately model the future. Second, you want post-closing accountability from your advisors so they don't sell you a nightmare. Third, you target recession-resistant moats, like physical vet clinics, to protect your downside. And finally, you utilize aggressive value-add strategies and 1031 exchanges to grow your money, avoid taxes, and eventually park that wealth in massive, stable properties.
Understanding this cycle makes you realize how these invisible calculations are literally shaping the physical makeup of our cities. The stores that survive, the clinics that open, the strip malls that sit vacant waiting for a value-add buyer, it's all driven by this exact underlying math.
Which brings me to a final, rather provocative thought to leave you, the listener, with today, because there is one listing in this newsletter that we haven't touched on yet.
The land in Mesquite.
Yes, in Mesquite, Texas. It's 2.2 acres of commercial land right on Gus Thomason Road, but EBG highlights a very specific detail about this empty dirt. It has flexible zoning. They note that both retail and multifamily residential are permitted to be built there. It has mixed-use potential. So consider this. If the ultimate goal of commercial real estate is to create safe, tax-deferred wealth through predictable assets, how will this rising demand for flexible zoning change the game?
It's a huge shift.
It really is. We are increasingly blurring the lines between where we live, where we shop, and where we work. How will that fundamentally change the very definition of a commercial property in the next decade?
That is the new frontier. When a single piece of land can simultaneously be an apartment building, a local coffee shop, and a co-working space all stacked on top of each other, calculating that risk and managing those different types of tenants becomes an entirely new discipline.
So the next time you're sitting at a red light and you look over at an empty grass lot in your city, or a tired-looking strip mall with a for sale sign, don't just see the grass or the faded brick. Look a little closer and wonder what complex, multi-million-dollar chess game is being played right beneath your feet. Thanks for joining us for this deep dive.